Hello, greetings, and welcome to Dividend Blasters. This is our 41st video, and the topic today is why I invest in CVS. Yes, I am an investor and I am a customer, and I believe that this is a really good investment. So, I'm going to talk to you a little bit about why I believe it's a good investment. I'm first going to talk to you a little bit about its history, its background, structure of the company, and I'll do a comparative analysis with some of its peers and competitors. I'll also show you some of the metrics. All right. First, I am not your financial advisor. This is not financial advice. The purpose of this video is financial education and information. It reflects my own personal opinions, my research, and my experience as an investor for more than 30 years. Please do your own research, do your own due diligence, and consult a financial advisor prior to making any financial investment decisions. Before we start, I want to thank you for joining us, and I would ask you to give us a like and subscribe to our channel, Dividend Blasters, and share this video with a friend or a family member who you believe would find this useful and informative. Let's press on. So, what is CVS? CVS Health Corporation provides health services in the United States. Three major business segments within the CVS Health Corporation. There's healthcare benefits, pharmacy services, and retail long-term care. Those three segments. The healthcare benefits segment offers traditional, voluntary, and consumer-directed health insurance products and related services. Most of us know CVS really through the last two segments. Next one is the pharmacy services segment. They offer pharmacy benefit management solutions, including plan design and administration, formulary management, retail pharmacy network management, mail order pharmacy. And by the way, I have used their mail order pharmacy and it is exceptional. I get a refill every month for one of my prescriptions and it comes on time and it's complete and accurate. Okay, specialty pharmacy and infusion, clinical and disease and medical spend management services. And then the last is retail long-term care segment that offers prescriptions and over-the-counter drugs. We're very familiar with that. Consumer and health and beauty products, personal care products, healthcare services through their Minute Clinic walk-in medical clinics. I'll tell you, I buy all my shaving cream, all my shampoo, and all my toothpaste at my nearby CVS. And I do like their clinic. I love going in there and putting my arm in the little sling and taking my blood pressure regularly, just to make sure that everything is on an even keel. All right, next one. The company was formerly known as CVS Caremark. They changed their name to CVS Health Corporation in September 2014. The second segment we already talked about, CVS Pharmacy, is currently the largest pharmacy chain in the United States by the number of locations. That's over 9,900 and total prescription revenue. They're big. CVS Health Corporation was incorporated in 1996, and they are headquartered in Woonsocket, Rhode Island. They were originally named Customers Value Service, and they were founded in Lowell, Massachusetts in 1963. Let's talk about the summary metrics. They closed last Friday, June 9th, at a price of $71.76, which should jump out at you in that lower panel on the right is the low PE ratio. The forward price earnings ratio is a low 8.32. It is less than half the PE ratio of the S&P 500 of 19.14, as well as the Dow Jones Industrial Average of 22.56. What does that tell us? That tells us that relative to the larger market, this is a very reasonably priced investment. I do like the earnings per share of 863. It is more than sufficient to cover that forward dividend rate. Market cap is 92 billion. It's a decent sized company. All right. Next one. Price return. So we're looking at returns, and we're going to look at price, and then we're going to look at total. Price return is just price appreciation, and we're looking at the max time horizon that we can go back and look at, and it's going to take us back about 30 years. So back to August of 1993, I think it's August. My eyes are correct. It's a 733% price return. That's not bad. Let me say here at the get-go that you're not going to get Microsoft returns or Apple returns or NVIDIA returns with CVS or with any pharmacy chain. You're not going to get them. You're going to get more gentle, stable returns. And that's fine because putting everything in a Microsoft or an Apple or NVIDIA in hindsight is a great move, but we don't work in hindsight. And so we need to spread our risk. We need to be smart. So we got to choose some safer investments because we want to preserve our wealth on our road to financial independence. So 733% is very good. All right, let's go to the next one. Total return. So total return is what we just saw. Price return or price appreciation plus dividends. Well, over the last 30 years, we are looking at a total return of 1,105%. So dividends account for almost 400% of that 1,100%. Not bad. So think about it. You buy shares in CVS, you get a dividend. If you have time on your side, you're going to drip 100% back into your holdings. You're going to do it for a number of years. You want to grow your holdings, and as you drip, you grow your holdings, your next dividend is going to come out a little bigger, and then you're going to drip them back in continually. And that is your dividend snowball. That's how it works. That's the way you do it. All right. Next. So let's look at our scorecard for dividend summary. They get very decent grades. Safety, they get a B minus. Why do they get a B minus? They get a B minus because the payout ratio is a very safe 25.8%. I might say it could be a little higher, but that's fine. Remember, payout ratio is the ratio of dividends paid out over earnings. And we typically don't like to see a payout ratio of more than 60%. We want to make sure that that dividend is sustainable. We want to get it for years. That's what we need to help grow our holdings, build that dividend snowball. The dividend growth score is a B minus. Well, the 5-year CAGR is 2.92%. That's not spectacular. And why is it 2.92%? Well, they had some flat dividend growth over the last few years. Didn't go down, but it stayed flat. They didn't increase it. But it should actually go back up, and it will go back up. I'm going to get to that. But I also want to add that as you dig a little deeper, you will see that it's a B minus because if you look at the 10-year CAGR, and I'm going to show you that on the next slide, it's a high score. So they were growing dividends for several years. And if you also look at the forward growth rate, I'm going to show you that. I'm getting ahead of myself. It's a good score. So that's why they get a B plus or B minus. Dividend yield is an A. They earn it. 3.37 forward yield is very good. Dividend consistency, well, they get a B. They've only been growing the last 1 year, but they haven't cut the dividend. It's been flat. And they have had several years before that of dividend growth. So it's a B. And I'll tell you, they keep it up, moving in the right direction. It could be a B plus next year. We'll see. All right. So we're going to dive a little deeper on the dividend yield. So as I mentioned, that forward yield, it's an A minus 3.37%. The 5-year yield on cost, 3.5%. That's an A minus. And take a look at the column next to you. It's the sector median. Okay, it is much higher. And I'm focusing on the shaded metrics that I get out of Seeking Alpha. Look at that free cash flow yield for the trending 12 months. It's 18.58%. This company does very well with its cash flow. And you're going to see that as we get to the balance sheet. Free cash flow for 1 year, 12.07%, almost 3 times the sector median of 4.6%. Pretty doggone good. So the major takeaway here is the dividend yield is very good. The cash flow is very good. All right, let's press on. Dividend growth. Well, this is why they get a B minus, because they're getting B pluses for the 1 year dividend growth rate for the trending 12 months. 10%. Wow, almost double the sector median. Look at that forward dividend per share growth, 8.92%, almost double the sector median. Okay, now we already talked about the 5-year cagr. That they're rating that a D plus, a 2.92%. It's not bad, but we want to see more. We want to see 6, 7, 8%. So when I look at the trending 12 months, a 10%, and I look at the forward dividend per share growth of 8.92%, that to me is giving me information that there is some good movement. We're moving in the right direction in the dividend growth area. All right. And also, we can go back to the 10-year CAGR. They have a history of growing that dividend. That 10-year CAGR is 11.5%, killing the sector median. Forward revenue growth, it's a little bit less than the median. I shaded it because I want to give you the full picture. Okay, it's not all roses. And these things are never simple, they're complicated. So that's why I wanted to show you everything. But I'd say the major takeaway here is that dividend growth is good and it's getting better. That's the key takeaway here. Who are their competitors? Well, I'm looking at Rite Aid and I'm looking at Walgreens Boots Alliance. Again, the market cap for CVS is 92 billion. Rite Aid, as you may have heard, is going through a lot of problems. Their stock prices, you will see later, is really low, which is really why they have a very low market cap. It's normally much higher. They you know what? I just don't want to talk about Rite Aid. It's just they're going through a lot of problems. Walgreens Boots Alliance is probably much closer, but it's really about a quarter the size market cap. It's around 27 billion. They have more people. Uh, CVS has 259,000. Walgreens Boots Alliance 262.5. I know they recently bought Dwayne Reed, the big New York-based pharmacy drugstore chain. So now it's Dwayne Reed by Walgreens Boots Alliance. If you go to New York, Manhattan, any of the surrounding New York area, you're going to see that. All right, let's press on. As I mentioned, Rite Aid is struggling. Look at the price versus the 52-week high. It's down 84%. Their last close is $1.82. Not good. Walgreens is around 31 bucks. CVS is 71.76, as I mentioned. All right, let's press on. So if you look at the total returns, I would say, let's just kind of skip over Rite Aid. You can see it there. It's not good. Not a good story. But CVS really has better total return against Walgreens Boots Alliance on all fronts. Walgreens Boots Alliance has had a tough road to hoe, I should say. The last 1 month, it's not bad. It's about 1.5%. It's about 1% less than CVS, but basically over the last 3 years, 5 years, and 10 years, it's been negative. All right, let's move on. Dividends. Dividends is a little different story. Okay, the dividend forward yield is good for Walgreens, 6.11%. It's more than CVS. And you can see it dollarized. Well, the forward dollarized rate is 242 for CVS. It's $1.92 for Walgreens. Well, how can that be if the yield is more? Well, the price for Walgreens is much less. It's less than half. That's why the dollarized dollar amount is so much smaller. The payout ratio is higher. 47% is not bad, okay, but 26% is safer. The 3-year cagr is better for CVS. The 5-year cagr is a little bit better for Walgreens Boots Alliance, 3.71% versus 2.92%. You got to give Walgreens Boots Alliance their due. They've increased their dividend for 30 consecutive years, so they're a dividend aristocrat. So that's something to think about. But I tell you, they've been struggling a little bit in the market with price return. So something to think about. All right. Dividend grades, I would say CVS gets better dividend grades. They do with dividend growth. They're tied with the yield. Dividend safety is better. Dividend consistency. Well, Walgreens is going to get an A plus because they've got the 30-year streak. But there are other things to think about, and I'm going to get to that. Like I said, these things are never simple. They're a little bit complicated. We do our digging. Valuation. Well, let's take a look. According to the numbers, the PE non-GAAP for fiscal year 1, 2, and 3 is higher for CVS than Walgreens Boots Alliance. Now, I got to tell you, I don't care too much about this because it's a PE of 8 versus a PE of 7 or 6. In the end, I'm looking at earnings. And, a PE of 8 versus a PE of 7 is not a big deal, especially when the market is 18 or 21 or 22. So, anyway, but I want to show you that for context. All right, let's move on. Let's look at growth. Well, year over year revenue growth, it's CVS, and it's not close. Walgreens Boots Alliance year over year is negative 1.95%. CVS is almost 10.5%. Forward revenue growth for CVS over 5%. Walgreens Boots Alliance 2.7%. Revenue 5-year 12.15% for CVS. Walgreens about 1.5%. So revenue growth, it's CVS, and it's not close. Now, I'm a little bit puzzled, and I did shade this. Net income 3-year CAGR for CVS is minus 18.34%. Aha. I would do some digging. So the revenue year over year growth is 10.42%, but the net income for the last 3 years compounded is negative. It leads me to believe that they had a very good last 1 year, but maybe 2 years before that, not so good. And that was probably due to the pandemic. Okay, let's go down. We look at the levered free cash flow. CAGR for 3 years, 14.5%. Walgreens Boots Alliance, minus 4%. Aha. I got to tell you, growth, it's looking better. It is looking better for CVS. Profitability, not even close. Net income margin for CVS, 1.19%. It's a narrow margin, but they're not losing net income like Walgreens. Same with the return on equity, 5.42%. Walgreens is negative. Return on assets, an eyelash under 5% for CVS. Negative for Walgreens. Deeply negative, actually. Return on total capital, 6.28% for CVS, 1.3% for Walgreens. Well, at least they're not negative there. Cash from operations, they really separate themselves. They're over 20 billion, okay, for CVS, a little under 3 billion for Walgreens. Walgreens is having some problems, okay? And I'm not even talking about Rite Aid. I just, as I mentioned, I'm just going to set them aside, but I would call them a peer. Net income per employee, $15,148. Walgreens, minus $12,000. It's almost as negative as Rite Aid. So CVS is the more profitable enterprise. That's what we want as an investor. Price performance. You just take a look. The last 1 month, it's CVS. 3-year, 5-year, and 10-year, it's deeply CVS. As I mentioned, Walgreens Boots Alliance is getting beat up. Negative and deeply negative. Minus 30%, minus 50, minus 36. Now, let's be fair. For the last 3 months, 6 months, 9 months, year to date, in 1 year, they've all lost price. Okay, they've all been going down. The market has been rough. So what do we look at to see where the differences are? Well, we look at the last 1 month. Maybe CVS. This tells me the CVS has probably turned the corner. Okay, and then we go back the last 3 years, 5 years, and 10 years, which is what I did. And CVS is deeply positive. The others are negative across every phase of this graduated time frame. Risk, the betas are very low, which means these are very gentle investments. You're not going to see a lot of price volatility. Last 60 months, 0.61. Last 24 months, 0.56. And remember, a beta of 1.0 is equivalent to the S&P 500, the larger market. This investment, CVS, is much less price volatile. It's a safe investment. Rite Aid is not. Walgreens Boots Alliance is not bad price-wise, but we know they've been going down. Price volatility has been negative consistently. But their betas are lower. So they go down a little bit more, but it's not as bad as Rite Aid, clearly. All right. Income statement. Revenue, CVS is a much bigger company. The revenue is $330 billion. It's not quite 3 times as much as Walgreens Boots Alliance, but it's close. Rite Aid is much smaller revenue-wise. Net income, a little under $4 billion. Walgreens Boots Alliance is about minus $3 billion. Operating income is a little bit under $15 billion for CVS. Operating income for Rite Aid, well, it says here $10.5 billion. I want to think about that a little bit because they're very negative on net income. Operating income is, well, it's not very high. $10.5 million. I was thinking it was billion. It's $10.5 million. So that makes sense. It's small. Their margins are being eroded because they have problems. Walgreens Boots Alliance, its operating income is $1.44 billion. So it's about 1/10 of CVS's. All right. That's the income statement. Balance sheet. This is really where I say that CVS sets itself apart. Total cash is over $17 billion. Walgreens is a little under $1.9 billion. So it's about 8 times much cash as Walgreens Boots Alliance. Total debt to equity, that ratio is a little bit high. It's over 106%. But look at Walgreens, it's over 130%. Rite Aid, they're not even measuring it. Can't be good. The long-term debt to total capital for CVS, 49%. That looks reasonable. Walgreens is about 47%. That looks reasonable. Rite Aid's is over 102%, which is kind of high. So the major takeaway here is they got a lot of cash. They have some debt, but the long-term debt is manageable over their total capital. This is a cash-rich company, CVS is. Let's look at net operating cash flow. Wow, 20 billion. 20 billion in net operating cash flow for CVS. Walgreens is a little under 3 billion, so they're about 6.5 times as much as Walgreens Boots Alliance. Rite Aid is negative. So that's all I want to say on cash flow. Major takeaways: they got a lot of cash and they generate a lot of cash. So, what are the key takeaways? It's more than a pharmacy, although the pharmacy is a huge segment. It's the largest pharmacy in the country. They're also a healthcare benefits and insurance company. They're very reasonably priced. PE ratio of 8.32, market cap 92 billion, trading at 71 bucks a share. The betas are low. It's a safe investment. I like the dividend yield, 3.42%. I saw 3.37%, so I saw some different numbers in Seeking Alpha, but they're close, about the same. The cagr for 5 years is only 2.92%, but it's going in the right direction. They have a history of increasing maybe over the last 10 years, and the forward cagr is moving in the right direction. Decent cash flow from operations, 20 billion. The price performance is better over the long term. They did get beat up a little bit in 2022, as did their peers. Decent operating income, long-term debt over equity, total equity, 49%. That's manageable. They're currently, as I mentioned, the largest pharmacy chain in the United States. They've got over 9,900 locations, and their total prescription revenue is above everyone else. That makes them the largest pharmacy chain. And folks, that is it. So I hope you found this informative and educational, and I thank you for your time. I would kindly ask you to give us a like and subscribe to our channel, Dividend Blasters, and share the video with a friend or a family member. Till our next video, have a great day and God bless.